Imagine that an investment could produce several different returns next year. We cannot know which outcome will occur, but we can summarize the possibilities using expected return. To calculate it, multiply every possible return by its probability, then add the results. For example, suppose an investment has a 50% chance of returning 10% and a 50% chance of returning 0. Its expected return is 0.5 times 10% plus 0.5 times 0%. That equals 5%. 5% is a probability-weighted average, not a guaranteed return. We'll now apply the same idea to an entire portfolio. A portfolio contains money distributed among different investments. The fraction invested in each asset is called its portfolio weight. Suppose 60% of our money is invested in stocks and 40% is invested in bonds. We write these weights as decimals, 0.60 and 0.40. For a fully invested portfolio, the weights should add to 1. Here, 0.6 plus 0.4 equals 1. So all our money has been accounted for. To calculate the portfolio's expected return, multiply each asset's expected return by its weight. Then add all the contributions. In symbols, the expected portfolio return equals the sum of each weight multiplied by its asset's expected return. For two assets, that means the stock weight times the expected stock return, plus the bond weight times the expected bond return. Let's calculate a complete example. Suppose 60% of a portfolio is invested in a stock fund. The stock fund has an expected annual return of 8%. The remaining 40% is invested in a bond fund with an expected return of 4%. Start with a portfolio formula and substitute the values carefully. The expected portfolio return equals 0.6 times 8% plus 0.4 times 4%. The stock contribution is 4.8%. The bond contribution is 1.6%. Adding these contributions gives an expected portfolio return of 6.4%. Notice that 6.4% lies between the bond return of 4% and the stock return of 8%. It is closer to 8% because more money is invested in stocks. We can also interpret this result in money terms. If the portfolio is worth $10,000, multiply 10,000 by 0.064. The expected one-year gain is $640. However, this does not mean the portfolio will definitely earn $640 next year. The actual gain could be higher, lower, or even negative. 6.4% is an average across possible outcomes. Sometimes a question does not give expected asset returns directly. Instead, it provides returns under different economic scenarios. Suppose the economy can experience a boom, normal conditions, or a slowdown. Their probabilities are 25%, 50%, and 25%. First, calculate the 60-40 portfolio return inside each scenario. The portfolio returns are 9.6% during a boom, 6.4% under normal conditions, and 1.2% during a slowdown. Next, multiply each portfolio return by its scenario probability and add the results. This gives an expected portfolio return of 5.9%. We could also calculate each asset's expected return first and then apply the portfolio weights. Both valid methods produce the same 5.9% answer. Expected return describes the average result across many possible futures. It does not measure how widely the actual returns might vary. That variation is risk. Two portfolios can have the same expected return, but very different levels of risk. Now consider three common calculation mistakes. First, use decimal weights. 60% must be entered as 0.60, not 60. Second, confirm that the weights add to 1. If they add to more or less than 1, check whether money is borrowed, left uninvested, or whether a value is entered incorrectly. Third, do not use a simple average when investments have unequal weights. Averaging 8% and 4% gives 6%, but that assumes equal 50-50 weights. Our actual 60-40 portfolio produces 6.4%. Unless instructed otherwise, calculate weights using each asset's current market value. Let's finish with a reusable three-step method. Step 1, list every asset's portfolio weight and expected return. Step 2, check that the weights add to 1 for a fully invested portfolio. Step 3, multiply each weight by its corresponding expected return, then add all the contributions. For our example, 0.6 times 8% plus 0.4 times 4% equals 6.4%. Finally, interpret the result correctly. Expected return is a probability-weighted, long-run average. It helps us compare investments and portfolios, but it is not a promise about what will happen next year.